Hey guys, welcome to another video. Today I'm going to do a little overview on how to value a company's stock using a discounted cash flow analysis. This is a model that is already built, and be sure to check the link in the video with this model, and I'm going to walk you through how to use it. And by the end, we will have a implied price per share that we can compare to the current market trading price to determine whether this company appears overvalued or undervalued based on our model and our assumptions moving forward. So to keep things simple, I'm going to pick a well-known company that everyone's familiar with, Apple. So just let me throw in the ticker symbol. Sorry, not paying attention. Alright. Okay, so we're going to pull last year's financials, so 2018's financials, since we'll have a complete overview of all their financials from that year. And since most of you aren't going to have access to any proprietary software like such as Bloomberg, unless you work for an investment firm, of course, then you might have access to that information. I'm going to show you how to do it manually, like as I like to say. It takes a little bit more work, but it's just as effective, and this information is public to everyone. So basically each quarter a company is going to release a quarterly report, and if we go onto Apple's website, they have a pretty good investor relations page. We can actually download their 10K from 2018 as well as 2017, 2016, 2015. That information is pretty irrelevant at this point, unless you're looking for something real specific. So we can go ahead and pull up 2018's 10K, as I already have done here, and it's going to give us some consolidated financial statements. As you can see, it was automatically on the balance sheet. So we're going to start by going up to their operations statement, or it's basically like an income statement. Wording tends to vary between companies. So we're going to shift back to the model now. As you can see, this right here is going to be our input section. So this is where we're going to pull all the information from the 10K and put it in here. And then over here, this is going to be our outputs. So I kind of highlighted that in yellow just to help it stand out. There's also some instructions which they're a little hard to decipher if you're not familiar with a discounted cash flow analysis. And then working our way down, this is just the operating summary. So when we put in our inputs, this section is automatically going to be filled in, except for this line right here. This is going to be assumptions as well. So assumptions are in orange, and then everything green is linked to the inputs, and then everything blue are the inputs. So just scrolling down here, the free cash flow is basically what we're going to be finding. So that's one of the main rows. That's why that's bolded there. We're going to get a little graph here at the end. Moving down, we are going to also have to put in some assumptions down here, and it's going to give us down at the end here, this is basically going to be a sensitivity analysis, which we can adjust based on how we want to look at the company, whether we want a wider range of variables or a closer range of variables, and I'll go over that more towards the end of the video. So first things first, we have to pull all the information from the 10K back on from the investor relations page. So this information is public. It's required by the SEC for every publicly traded company to give their investors this information and be as straightforward as possible. So the first thing we're going to look at here, I know on this model you're seeing revenue. Like I said, certain words are going to vary from company to company. So instead of revenue, we can just pull from the 10K, we can just pull the net sales. And one thing to also keep in mind when putting in all of our inputs, everything is in millions, so it's actually going to be 265 billion, for example. So we'll go ahead and plug that number in. So we have 265, okay. And then COGS over here, which is cost of goods sold. A quick explanation, like a cost of goods sold is basically anything that, any cost that is going into creating the actual product itself. So for example, anything that is used to make an iPhone will be considered a cost of goods sold. So we can go back to the 10K, and that's going to be cost of sales in this example. So we'll pull that 163 million. We'll put that back in our inputs tab. 163 million. Okay. And then over here we have SG&A, which is selling, general, and administrative expenses. So for example, that would be all of your staff, higher ups, your managers, things like that. It's a real quick explanation for that. That's going to be down here in your operating expenses, selling, general, and administrative. So that's going to be 16 billion. Go ahead and put that in. So depreciation, to find that, we're actually going to have to work our way down to the cash flow section of the financial statement. Sorry. Let me see where we at. I think we're down farther. Okay, here we go. So they provide us with a consolidated statement of cash flows, and then as you can see, our D&A is right here on this line, our depreciation and amortization. So we can go ahead and fill in that. So it's going to be 10 billion. And then we also have our Capex, which should have been, our capital expenditures should have also been on this page. Let me check. Okay, actually, so it's actually kind of misleading a little bit. Our Capex is basically property, plant, and equipment. So we can derive the PP&E or the Capex because under they have it listed under their investing activities section, and it says payments for acquisition of property, plant, and equipment. So we can assume that Apple spent this amount of money on their PP&E. So we can go ahead and pull that number, that 13,313,000,000. So that one's a little more tricky. Another method you could do, if you're digging through a company's 10K and nothing's popping out to you right away, go ahead and do a quick Google search on something, because if a company reports, that Apple spent 12 billion on their PP&E, you could still use that number. The more important part is the assumptions that we're going to put into the model. So as long as you're within a couple million, when you're putting in like the revenue, cost of goods sold, everything like that, you will still get a decent output at the end. So we go ahead, we've got our PP&E. So our net working capital is going to actually be a little bit of a formula that we're going to put in here. So basically our NWC is going to be our current liabilities minus our current assets, and that's going to give us, like a working capital, like day-to-day current assets minus current liabilities, like how that's kind of showing how the company's doing in the short term. If, for example, Apple's a very strong company, so some companies might have a lot more current liabilities than they do current assets, which can become a problem if they're not cash flowing well, or if they have a certain quarter of the year where they perform a lot worse. So that can turn into a bigger problem for those companies. Whereas Apple, as you will see, we'll go back up here. That's going to be found in the balance sheet. So we have our current assets section. So we'll take our total current assets here, and our total current liabilities down here. So we're going to do our this 116, I think it was 826 minus 131, 339. Okay. So there we go. There's our net working capital. And then for our net debt as well, this is going to be another formula. It's going to be short-term debt plus long-term debt minus our cash and cash equivalents. So this is basically showing the total amount of debt minus the amount we could technically pay off if we wanted to today. So breaking it down in more of a personal finance section, or personal finance example, excuse me, if you had like $20,000 in student loans and you had $10,000 in cash, technically we would look at that like, okay, I had this $10,000 in cash, I could pay down half of my student loans. So in that case, we look at our net debt as only $10,000 because we have the option to pay off half of it. Now, is that the best decision for the company? Well, it depends. What is that interest rate on the debt? If that interest rate is, let's say, 3-4%, and we think with our cash we can get a 7 or 8% return, why would we pay down that debt then? It wouldn't make sense for the company to do that. So if we go back into our 10K, we can see we have our total liabilities here. So this is just going to be our total current liabilities plus our total non-current. Apple has it listed as total non-current liabilities. That's the same as long-term debt. So we can go ahead and do the 258. So 258,578. And then we also have to account for the cash and cash equivalents, because that's the amount where Apple could be like, hey, we don't like this debt anymore. Maybe they watch a little bit of Dave Ramsey and they're like, we don't want any more debt. So you go up here back to their assets section and you can pull this from the cash and cash equivalents, and that's going to be 25,913,000,000. So plug that in, and then now we have our net debt right here. So moving on down, we need a tax rate. So as most of you know, Trump lowered the tax rate for corporations, which is kind of attributing to why the stock market had such a good year right after Trump got elected. So he lowered it to 21%. So when doing these discounted cash flow models, a baseline you can use is 21%. Some companies' effective tax rate is lower. Some companies' effective tax rate is higher. You could do a quick Google search. I found, varying sources say Apple pays like an effective tax rate of 16.5%. It's some of this information is a little harder to come by with companies, because there are certain things that they don't have to completely disclose to their investors. So I like this to keep a baseline for like tax rate 21%. If you want to be even more conservative with your model, maybe give your company like a 25% tax rate, or make it a little higher just so the numbers are more conservative. So for weighted average cost of capital, this would be another good video that I could put together. Basically, it is the WACC as it's referred to. So it's going to be the cost of the equity and the cost of the debt and the cost of any preferred stock all blended together. So we're not going to get too far into that. I pulled a number for Apple. You could Google this. That'd probably be the easiest method, because you guys won't have access to any software platforms where you could find this information. So I would do a quick Google search. Like I said, you could also be conservative with this. If you find like 7%, bump it up to 8% just to be a little more safe. But we're going to go ahead and go with 7.6% for now. Moving on to the perpetual growth rate. So this is going to be one of the most important, and I can't even say it enough, this is going to be the most critical portion of the discounted cash flow analysis. So basically, perpetual growth rate is going to mean the quote-unquote growth rate to infinity of the company. And one of the beliefs that I have, and it's very important to note this, there's going to be a lot of debate around perpetual growth rate. Certain companies that are already well established, like a company like Walmart, they're going to get a much lower perpetual growth rate than, say, a newer tech company. Because Walmart is already so big, and how much more can they possibly grow? You know, they already have such a big market share. Same with like Coca-Cola. They have such a big market share that they almost can't expand anymore, and the perpetual growth rate needs to be a little bit lower. Apple, on the other hand, is also a very big company, even though it is a tech company, and you know, sometimes they can have higher growth rates because technology is always adapting and they're finding new markets. So Apple probably could get a higher perpetual growth rate. But one thing I really, really, really believe in that is important is that the US economy grows at about 2 to 3% every year on average. And for it would almost be impossible for, well, it is impossible for any company to outpace the US economy forever. It can't happen. So with that being said, you can't really have a growth rate above 3%. It just doesn't make sense at all. So for this one, we're just going to put in a 2% for now. And then before I even move further, I just want to show you how sensitive the perpetual growth rate is. Let's say I put in like an unrealistic perpetual growth rate of 5%. Look at our stock price. It just doubled. It went up over 100%. It went from about 152 all the way up to 342, and that was moving our perpetual growth rate from 2% to 3%. Even if we go down to a 3%, that's a huge increase on our 152 that we had earlier. So this perpetual growth rate has a major effect. And if I was putting together a presentation for somebody trying to explain, you know, why to buy this company, I would be uberly conservative with perpetual growth rate just to prove to them that the company is a great buy. You know, if you go in there and you're like, oh, well, I have perpetual growth rate set at 3.5%, they're going to be like, that doesn't make any sense. And if that's the only way you can make that company look like a good buy, it's probably not a good buy unless the company, you know, isn't producing any free cash flow at the current moment, and the only reason the stock is trading it's what it's trading is because of, you know, future value. For example, a company like a newer company like Beyond Meat, you know, their IPO is skyrocketing. Are they even making money yet? No, they're not. Like a lot of new IPOs, they're not even making money, so like you can't even really do a DCF on them because you're not getting any free cash flow. So like the intrinsic value, it just isn't there. So let's keep this at 2% for now. And then working our way down, as you can see, all of these are filled in now automatically. This is what's so nice about the model. You can do a DCF by hand, but with Excel and the technology available, these models are just so helpful and they make your life so much easier. And then as you can see this line, so up above, we put in a positive number for Capex, but the model knows when we're doing a free cash flow formula that Capex is subtracted out when we're finding free cash flow. So the model automatically does that for you, as you can see right here. So like when I was pulling the 10K, capital expenditures was actually a negative number. So if you were to go, oh, okay, it's a negative number, so let's put in a negative number for Capex. Then the model counts that as double negative. It comes down here, makes Capex a positive, and it adds that in at the end, which is not what you want to do. It shows a lot higher free cash flow. It's like, hey, we just spent all this money on property, plant, and equipment. Let's add that to our free cash flow. That just doesn't make any sense. If you go and buy a house, you're not going to add that to your monthly income. You're going to subtract that. So make sure you don't make that mistake when you're pulling your PP&E or your Capex. So as you can see, our stock price is about 258 because that looks awesome. We're spending all that money on PP&E and we're adding it to our free cash flow. So that's an easy mistake that people can make. So one more assumption that we need to put in is our revenue growth for each year. Now, this I'm going to do, since we don't have much time, we're going to do a very, very simple way to do revenue growth. So basically, you go back 5 years and you just take an average. And I've already done this just to save time for the videos. So I found one online, and we're going to use 9.22% for their 5-year. And this isn't as accurate either because of the fact that, we've been in a bull market the past at least 10 years, 11-ish years. So, moving forward, like I would say, in here, Apple's not going to do that every year. They might only have, like, let's say a 3% there. Maybe they have a year where they don't have any revenue growth. And then, let's say they're just going to go up 4. And then we'll say we'll keep that at 9.22 again, so we can play around with this a little bit. This is where you need to do a little bit more in-depth research, read company reports. If Apple comes out, releases a quarterly report, and they're like, hey, for 2019, revenue growth is going to be down. We're only going to maybe do 3% year over year in revenue growth. So we can put in 3% and see how the share price is going to be affected if that holds true. But if Apple comes out, this is where you see the fluctuations too, because these models are automatically being calculated. Fund managers this information is going in automatically. They're getting an implied price per share. Apple comes out and they're like, hey, 10% revenue growth year over year. Like a manager's going to look at this and be like, whoa, Apple should be trading at 224. Let's start buying. So that's just some of the things that like a model like this can do for you. So coming down here, there's one more adjustment we have to make to the model for us to get an accurate answer. And I already had this inputted in just to make sure I didn't miss it. But short-term investments, this can also be, I think we can find this in the 10K. I don't want to spend too much time digging through there, but I had 40,388,000,000, which, like I said, you can find that in the 10K or do another quick Google search. Same with the diluted shares, that is also in the 10K, or you can do a Google search. And Apple currently has about 4.7 billion shares outstanding. So that's a very important piece of the model too, because if the model's preset on like 300 million shares or something, so if you only had 300 million in the model, there, I'll just show you quick. Like I think it's preset on 300 million. So if we do that, Apple share price is going to be, yeah, exactly. So 3,517 per share. So that's not what we want. So just make sure you adjust the diluted shares. We also can make an adjustment if we want to. I kind of like the preset that it's already on. So we're going to do a discount rate sensitivity step of just 1%. And then we're also going to do a perpetual growth rate sensitivity, which goes back to here where I did 2%. And if we adjust this sensitivity, it'll show us the stock price at 1.5% perpetual growth rate and 2.5% perpetual growth rate, which is very, very effective if you're putting together an argument on why to buy a stock. So if we come down here, look at the free cash flow summary, and we go over this information, and we're trying to talk to investors or someone else, just trying to convince them, hey, here's why you need to buy Apple. So we come down here and we're like, okay, so we're going to estimate that we're somewhere here in the middle with our growth rate. This is our low end for what we think Apple could be trading at, 183, rock bottom. On the upper end, we think Apple could be all the way up to 283. This is just based on the discount rate at a 2% perpetual growth rate. What's even more effective is if we're like, okay, so we have a range of growth rates that Apple could grow at perpetually. Let's say low end, we're looking at 171. high end, we're looking at 316, which that 316 is pretty unrealistic. So I like to focus on the downside risk. And this is also what a lot of people like to consider, because it's quote unquote like you could buy a company at like a value, or kind of like a wedge in real estate. You have like a wedge deal. You like to buy a company, so you only have so much downside risk. So we could look at this and be like, hey, we're assuming a really low perpetual growth rate at an 8, around an 8.5% discount rate, and we're coming up with Apple could be trading no lower than 171 a share. That's not far off from what it's trading at right now. So we have a lot of, we're really limiting our downside risk. And this is very important when looking at a company. Maybe it's not looking at this 316, shooting for the moon, but when we're buying, looking at, hey, Apple, the lowest it should be trading at is 171. Whereas you might have another company and their downside risk is not worth the upside risk, for example. So now, what do we do with this information? I kind of talked about it there a little bit. It was a little confusing. If one of you have never used like a discounted cash flow before, probably some of you don't even know what a discounted cash flow is at all, and that's perfectly fine. This is just a little bit of introduction how to use the model. So we come over here and we have, our enterprise value and our equity value. Like what are those? What does that even mean? So basically our enterprise value is, the total market cap of the company plus all their debt. And that's going to give us our enterprise value. And Apple is a giant company. Their enterprise value is at $1,247,507,000,000. Whereas their equity value, which is the total market cap of the company, which can be found by multiplying the number of shares, which would be that 4,701,000,000, times the current stock price, and then you'll get this 1,055,230,000. Sorry, I said that completely wrong. It'd be 1,055,230,000,000. Apple is just such a giant company that it's honestly hard to even read that number. But why do we put in all these inputs? So basically, we did all this work to figure out what our implied price per share is. So what this means is, based on all of the inputs and all of our assumptions, Apple should be worth $224.47 a share. And why is this important? If we go back and let's say we do a quick Google search, we search for Apple. Apple's currently trading at $199.46, so just south of $200 a share. Based on this model, we think that Apple could be worth around $224 a share. When we went back to our sensitivity analysis, downside, we think low-end Apple should be worth no less than 171 if it has a bad day. Upside, we had that 310. That's probably not as realistic. We could say, based on that 2% perpetual growth rate, Apple could be worth up to $260 to $280 a share upside, with not a lot of downside risk. So this is just one example we can use on why to buy Apple, because we believe it should be worth $224.47 a share. And this, this isn't foolproof either. Companies can have a bad quarter or change their guidance, which it happens all the time. But this is a very effective way to get an idea for how much a company is worth. And if they're producing money, then we can put a value on the company if we want to. So I really appreciate you guys for watching. If any of you made it to the end, that's awesome. Feel free to like the video and subscribe. I hope this was helpful. I know there's a lot of information in here, and I can go even in more depth on some other videos and explain some of the smaller pieces, like weighted average cost of capital would be a great video, and even just some general videos on stock investing and real estate investing. So once again, thank you guys. I hope you all have a great day.